this year especially, with the broadening of the market, stay diversified in your portfolio, and particularly over the long run. Good morning and welcome to Life in the Markets. My name is Stephen Rohr and I'm a wealth manager here at the Life Financial Group. Hope you had a wonderful weekend. This past week in the market, it was largely a flat week. The S&P dipped slightly through the middle of the week, especially with some increased tensions in Iran and seeming fallout of the ceasefire there. However, it did end up over 1 percentage point. So still a good week. Equal weight, however, was down ever so slightly at negative 0.28%. One thing to note is that the equal weight S&P 500 is up almost 12% year to date, while the cap weight S&P 500 is only up a little over 10% on the year. This makes more sense if you dig a little deeper. The Magnificent Seven, so those big name companies that you've probably heard about, Microsoft, Nvidia, etc., they have largely been a little down or flat as an average between them year to date. So, for instance, Microsoft, just Microsoft alone, was down almost 20% on the first half of the year. So that, combined with the others being fairly flat, have kept them down. And since they make up over 33% of the cap-weighted S&P 500, which we discussed in more detail a couple weeks ago when I was with you, that has kept the cap-weighted S&P 500 from growing quite as much. The equal weight, however, has grown more because all of the other companies, the non-Magnificent Seven, the 490 plus, they have gone up significantly this year. Again, that's just an interesting thing to note as the economy broadens out and the growth broadens out. And this really is a good sign, and we are encouraged to see that the growth is spreading out among more companies and not just the concentrated few. Elsewise, this week, the NASDAQ ended up 1.69%, which was a good week for them. The Russell 2000 was down a little bit, negative 0.82%, and the International was also down a little bit, basically flat. Gold and silver, they were both down again this week. Year to date, gold has gone down about almost 5%. Now, silver year to date has gone down almost 18%. It started about here and then it really jumped up and then it's gone back down again. So it has had quite the roller coaster ride this year so far. Oil is up this past week, but still down from its highs, that we saw a few weeks ago or a month or so ago. Bitcoin is also up a little bit on the week, 1.8%, but down significantly, almost 30% year to date. Bonds were largely flat, a little bit down for the ag, and the 10-year Treasury, however, was up about 2.5%. So it's fairly significant growth there. Now, another metric, diesel prices. Diesel prices were up because of another major war that has taken a little bit of a backseat lately, the Ukraine-Russia war. Ukraine has hit several of the Russian diesel refineries, and this has actually had an impact on the global price because 11% of global diesel supply comes from Russia alone. On the other hand, oil prices, they have gone up a little bit, as we mentioned. Not too much, but a little bit because, as we mentioned, the ceasefire has broken down a bit between the U.S. and Iran. And therefore, there's been a resumed disruption to the Strait of Hormuz. The overall market is not getting too hung up about this, as the day-to-day drama of this war and President Trump's dialogue back and forth with Iran is largely getting tuned out by the market. Not entirely, but they're starting to not get too worried by the latest tweet there. As far as domestic prices go, initial jobless claims dropped a bit from 217,000 to 215,000. This is good because it means, of course, less people were let go from their jobs. However, there are some problems in the workforce that we may be seeing here. In June, there were 720,000 less participants in the U.S. workforce. So it means 720,000 people left work. And they left looking for work, they left applying for work, they left the workforce. It's not all bad because it certainly includes a significant portion of retirees as they see the market is doing well and they are hitting the summer period where it made sense for them to retire. So some of that is natural and to be expected as the large boomer population is going to be retiring here over the next years. Now, a negative and perhaps a positive is that existing home sales have continued to be slow. So while healthy turnover and steady movement of homes is overall best, the slowing sales could eventually help the prices adjust down to levels that are more achievable for young families and first-time home buyers. Now, this is exceedingly important, as owning a home is a key component to many families' decisions to grow and have more children. Now, the prices have not come down yet. They are actually up 1.8% year over year. This week, looking ahead, there are a couple things that we're going to be keeping an eye on. The CPI will be releasing new inflation data. This will be very interesting to see. Despite oil prices coming down over the last month or so, the lagging effect of high oil prices will likely take some time to work through the system. As we've been discussing, the elevated oil prices have a trickle-down effect on the cost of transporting goods and manufacturing goods, and all of that takes a little bit to show up in the price that we see in the store when we're buying something. So just because the prices come down now, the cost to make the goods that is just being put on the shelf is affected by what happened a couple months ago. It will take a little bit for that to work out. Consumers are actually expecting that. There was a consumer expectation survey that went out this week and found that people were expecting inflation to be a little bit higher and not lower. So that's good that people are pricing that effect in. The new Fed chair, Kevin Warsh, will be testifying in Congress. He will probably play the Fed's outlook pretty close to the vest and continue his policy of not using forward guidance as a tool. More likely, he will be on the defensive, trying to explain that the Fed is still independent from the president. That is more likely the cause and reason for the Congress to be calling him and interviewing him. I think there won't be as much that will affect the market or the market's expectations, which is what Kevin is planning on doing as the Fed chair. As we've been reminded this year especially, with the broadening of the market, stay diversified in your portfolio, and particularly over the long run. This can be hard to do when there are hot items that are really on fire for a certain period, but over the long run, staying invested in a broad sector and different types of companies will help your return and will balance things out, because there are many things that we don't know, both on the macroeconomic level, but even on an individual company level. King Solomon reminds us of this with our verse of the week, Ecclesiastes 11:2. Invest in 7 ventures, yes, in 8. You do not know what disaster may come upon the land. I hope you have a wonderful rest of your week. and enjoy the summertime weather and get outside with your family and enjoy the beach or the pool or the lake. And we hope to see you again next week. Please like and share with those who you think would find this useful. And we will talk to you soon.
The topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investing and investment strategies involve risk, including the potential loss of principal. Past performance is not a guarantee of future results. All information herein is from sources believed reliable, but is not guaranteed for accuracy or completeness. The team assumes no liability for any errors, omissions, or actions taken based on this material. Information is as of the date stated and subject to change without notice. Securities and advisory services offered through Genius Wealth Management, member FINRA and SIPC.